Gold and silver prices took another dive last week following the US CPI and non-farm payroll volatility risks. However, key levels remain in focus to confirm the sustainability of these pullbacks. So starting with the gold chart, we will be analyzing the price action of the breakout beyond the bounds of a consolidation that extended on the charts since the highs of the 1980s, and that is roughly between the lows of November 2024 all through the highs of 2026. I also like to shed light on the relative strength index indicator, which is at overbought levels last seen in 2010 and in the 1980s that preceded levels that preceded extended drawdowns of the charts, which are raising potential drawdown risks on the gold price, on gold prices and silver prices as well before the bullish trends can comfortably resume their course. Now, if we drop down to the 2-week time frame and we take the Fibonacci retracement tool and place it at that mentioned trend between the lows of 2024 and the highs of January 2026, we can see that the price action and the latest corrective phases on the trend aligned perfectly with these ratios. So the latest drop in gold aligned near the 4,400 mark, which is a 382 Fibonacci retracement, where we had a steep dip buying opportunity back above the 4,900 mark at least. Now, key levels following that, if we manage to have a clean hold back below the 4,750 and the 4,400 mark, we can be expecting potential drawdowns towards the 50%, the golden 618, and the 786, which align with the 4,000 psychological threshold, followed by the 3,700 mark for potential dip buying opportunities. Now, in extreme case scenarios, we can be expecting drawdowns all the way towards 3,200 and 2,700, aligning strictly with the upper bound of this consolidation before the primary bull trend resumes its course. Now, from the upside, we can be taking the Fibonacci extension tool to be able to assess potential upside targets on the gold chart, and we can be placing it on the trend extending between the lows of 1999 all through the highs of 2011, and then going down towards lows of 2016. So over here, we can see the price action is aligning near the 2.618, with the next key levels in sight near the 6,000 mark and the 7,000 mark, respectively. Now, if we look at the gold chart back from a 3-month time frame perspective, we can see a potential cup and handle formation, and if that were to reach its full potential, we can be looking at gold prices beyond the 10,000 threshold. Now, with respect to the silver chart, we're also looking at a very similar pattern, which is also a consolidation extending on the chart since the 1980s, and we are analyzing the price action of the breakout beyond the bounds of this consolidation. We also have momentum at the relative strength index indicator at overbought levels last seen in 2011 and 1980, which is also raising risks for potential drawdowns before the bullish trend resumes its course. Now, key levels in sight over here, we can be taking the Fibonacci retracement tool and placing it between the lows of October 2024 all through the highs of January 2026, where we can see the price action aligned with the golden 618 near the 64 mark with its latest sharp rebound. The next key level in sight is near the 0.786 Fibonacci retracement, near the 47 to the 48 mark, lining back with the upper bound of this consolidation for potential dip buying opportunities. Now, in terms of the upside, we can be taking the Fibonacci extension tool and placing it between the lows of the 1990, the highs of 2011, and down to the lows of 2020, where we can be assessing potential upside risk or upside targets for the silver prices. Now, we're currently at the 2.272 clean hold above this bound, above the 117 mark, is expected to extend gains all through 130, 150, and all the way towards a 200 mark. Also taking into consideration, if we were to be assessing a potential cup and a handle formation, we can be looking at silver prices going towards the 200 and towards the 600 marks, respectively.